this is a great buying opportunity. Yes, this week, both gold and silver went down, but they're totally different assets. One of them is a buy, gold and silver. Bitcoin is just air coming out of a bubble. And so one of the opportunities that people have who are still in Bitcoin or in strategy or stretch, you can sell, and then you could take your money and you can buy gold and silver that have also gone down. Because Bitcoin's not going back up to make a new high at 120,000 from 60,000, but silver can easily go from $60 to $120. And when silver doubles back to its old high, now you're even, right? Instead of losing more money. And I don't think silver is going to stop there. I think silver's got a long way to go. I think 120 will just be a stop on the way to 200 over time.
Silver could be heading toward $200 over time, even after one of the sharpest corrections seen in recent years. Although many investors have focused on the recent decline in gold and silver prices, the broader bull market remains intact and may be setting the stage for another major advance. Peter Schiff, a veteran economist and longtime advocate of precious metals, argues that recent price weakness should be viewed in the context of a broader secular trend. In his view, persistent inflation, weakening economic fundamentals, and misguided confidence in monetary policy continue to support higher gold and silver prices over the long term. The recent sell-off pushed silver toward the $56 level and gold briefly below $4,000, creating extreme pessimism across the precious metals sector. But silver previously surged from roughly $30 to $120 in a remarkably short period, making the latest correction appear more like a reset than the end of the trend, with expectations that silver could eventually revisit $120 and continue toward $200. The current weakness is increasingly being viewed as a significant buying opportunity. Now we present the clips from Peter Schiff's interview. Before we continue to discuss this, please hit the like button, subscribe to the channel, and ring the bell icon. Thank you, and enjoy the video.
It was gold itself. Real gold also went down quite a bit. In fact, gold this week traded below 4,000. The low on gold was $3,970. Now, we didn't close below 4,000. We had a little bit of a recovery the past couple of days. So all of that decline took place Monday through Wednesday. That's how bad it was. Gold closed today up about $62 at $4,088.60. Silver down even more. In fact, silver dropped 11.3% on the week, but it closed significantly off the low. Silver got as low as $55.99, so a penny below 56. It closed at $59.05, so still below 60, but it was a big shakeout in gold and silver. I think we hit a lot of stops because I think some people might have had stops not just below the low, but below 4,000. And when gold was below 4,000, and it spent 2 days during the week where it traded below 4,000, Wednesday and Thursday, sentiment got very, very negative on gold. And it's as oversold as it's been in many, many years. In fact, I think it's more oversold now than it was overbought when it was at 5,600. So I think that negative sentiment hitting those stops, there's a good chance that that's been it, that's the bottom of this decline. Silver, never got back down to 50. I don't expect it to get down to 50. And honestly, I didn't think it would get this low, but it did. But given the context of the bull market, $59 silver compared to where it was a year ago, this is a huge bull market. It is a big breakout. Yes, silver is down more than 50% from its peak, but it tripled before the drop. So silver went on a rally that I've never seen in my career, where in a very short period of time, it went from 30 to 120. So the fact that it pulled back, and again, remember, the catalyst for the pullback was the war. The war started, and it was a buy the rumor, sell the fact, because part of the reason for the rally in precious metals was the anticipation of the war. Then the war started, and it was already overbought, and we had a buy the rumor, sell the fact. But the more recent next leg down was all about Kevin Warsh and the perception that he's some uber hawk, that he's the reincarnation of Paul Volcker. He is not. And all this talk, all this tough talk is just talk. I don't know if the Fed is going to raise rates at all. The market is now pricing in 2 or 3 rate hikes, but they're quarter point rate hikes. Even if we get them, they're too little too late to actually bring inflation down to 2%. They need much more aggressive interest rates, which are not going to happen. But I don't even know if these hikes are going to happen. Because if the Fed really was going to hike rates, why didn't they do it at the last meeting? They had plenty of opportunity. No, what did they do? They established not committees, task force. They have 5 task force now to study. So they may not do anything until they get the recommendation of these task force. And by the way, the longer they wait to hike rates, the less likely they are to do it. They might actually cut. And it's not going to be because inflation is coming down. That ain't going to happen. Inflation is going up. If they cut, it's because the economy is weak. It's because the stock market, the real estate market are weak. It's because bond market might be weak. That's why they're going to cut. They're going to cut despite inflation going up. In fact, look at the news that we got this week on consumer electronics. Big price increases from Apple on the iPhone, on iPad. I know Microsoft really jacked up the price of the Xbox. These are the biggest price increases percentage-wise I've ever seen. And one of the benefits, has been in consumer electronics. Prices have gone down in many cases over the years. That has offset the increases in food and energy and other things. So that's been a bright spot. Consumers have had some relief that, yes, I pay more for just about everything, but at least my electronics are gotten cheaper. Now, they're going up faster than ever. Now, you can say, well, that's because of the AI race, and it's because of memory is so expensive now, these chips. Yes, sure. But these prices are still in the CPI. Falling consumer electronic prices were helping to bring down the overall CPI. It offset some of the gains. Now, those price increases are going to add to the gains. In fact, make them even bigger because of the magnitude of these increases. So there's no way inflation is coming down. Inflation is going up, but that does not mean the Fed is going to hike rates. Again, Warsh said it was a choice, and he's right. And I expect him to choose inflation. Yes, he's posturing now that he's not going to choose inflation, but he's going to make the same choice that Greenspan did, that Bernanke did, that Yellen did, and that Powell did. They all made that choice for a reason, because if you choose not to have inflation, then you're choosing to have a recession, because you have to, you have to take away the punch bowl. We have to go through a withdrawal from all this cheap money. We have to contract money supply and credit. The Fed doesn't want to do that because it doesn't want a recession, doesn't want a big increase in unemployment, doesn't want stocks to crash, doesn't want real estate to crash, doesn't want to create another financial crisis. These are the things that are going to happen to really get rid of inflation. So Warsh can talk about it all he wants. He ain't going to do it. And it would also force fiscal responsibility on the government. It would force the government to cut spending or raise middle-class taxes. And why would Donald Trump, who spent the first part of his presidency calling Powell an idiot, a moron, a low IQ, a stupid person, too late pal, because he refused to cut interest rates? What is he going to do if his replacement raises interest rates? Something that Powell wasn't doing. He was just staying pat. And Trump was all over the guy. So politically, I don't see how this can happen.
The recent correction has also highlighted the growing disconnect between precious metals and speculative assets. As enthusiasm surrounding cryptocurrencies and risk-driven investments has faded considerably, gold and silver continue to be supported by fundamental economic realities. Inflation remains elevated, government debt continues to expand, and confidence in central bank policies is becoming increasingly fragile. Much of the market volatility has been driven by expectations surrounding the Fed, interest rates, and future monetary policy decisions. Yet higher rates have not eliminated inflationary pressures across the economy. consumers continue to face rising costs across many sectors, while fiscal deficits remain historically large. In this environment, precious metals continue to serve as an important hedge against currency depreciation and financial uncertainty. Although short-term price swings can be dramatic, the larger macroeconomic backdrop remains favorable for hard assets, particularly as investors seek protection from persistent inflation and growing economic instability. Now, let's get back to the interview.
The arrogance of Greenspan was that he believed that he could use his own judgment to create a de facto gold standard. And that's what he said he was doing. When he was testifying before Congress and asked about the gold standard, he said that he used gold as his main indicator. He said that if gold is up to $400 an ounce, it means I'm too loose and I got to raise rates. If gold goes below 300, I'm too tight and I got to cut rates. So he was claiming that even though we weren't officially on a gold standard, unofficially we were, because he was using gold as a way to know whether he had the interest rates right or wrong. Because how are you supposed to know? You just can't guess. You need some kind of market indication. And Greenspan said the best indicator of whether or not you have interest rates too high or too low is the price of gold. Well, if 4,000 meant he was too loose, if $400 gold meant the Fed needed to hike rates, what does $4,000 gold mean now? It means they really need to hike. They're way behind the curve, right? Based on Greenspan's criteria, the Fed needs, massive rate hikes, quantitative tightening. So he was the best one as far as understanding, yet he still made these mistakes. He still chose inflation over the alternative. When the stock market crashed in 1987, Greenspan chose inflation, right? So if a guy like Greenspan, a gold bug, when push comes to shove, if he chooses inflation, why is Warsh going to be any different? He's not. And so the markets, gold and silver, are pricing in rate cuts that are probably never going to happen. We're going to have, rate hikes. The market is pricing in rate hikes that aren't going to happen. And so this is a great buying opportunity. Yes, this week, both gold and silver went down, but they're totally different assets. And one of them is a buy, gold and silver. Bitcoin is just air coming out of a bubble. And so one of the opportunities that people have who are still in Bitcoin or in strategy or stretch, you can sell, and then you could take your money and you can buy gold and silver that have also gone down. Because Bitcoin's not going back up to make a new high at 120,000 from 60,000, but silver can easily go from $60 to $120. So you'll make your money back even if you bought Bitcoin at 120,000. You don't have to make that money back in Bitcoin. You can get out of Bitcoin, take a tax loss, put that in your pocket, and maybe even file a lawsuit if you just bought Bitcoin, I don't know, but if you bought strategy, you can. But you take your tax loss, and now you buy some silver. And when silver doubles back to its old high, now you're even, right? Instead of losing more money. And I don't think silver is going to stop there. I think silver's got a long way to go. I think 120 will just be a stop on the way to 200 over time. So you can make back your losses from crypto and fool's gold by getting into the real thing. The Fed is still creating inflation. How are you going to fight what you're creating? So again, it's all talk. You got to look at what the Fed does, not at what they say. Because talk is cheap. They're trying to buy some credibility with tough talk. Because, the Fed also places a lot of stock in expectations. They think that inflation is a function of expectations. And if they can get people to expect less inflation, then they think we'll get less inflation. By the way, we did get the consumer sentiment numbers out. And consumers are looking for inflation over the next year at 4.6%. So way above the 2%, but it is lower than the 4.6% that they expected the prior month. And the actual number, the consumer confidence number, is 49.5. So below 50, it's still a very low number, but not quite as bad as the 48.9 from the prior week. In fact, I think the worst economic news that came out today was our trade deficit in goods, which came out at $5.8 billion, which was substantially above what had been expected. I think it was a 28% increase from the prior month for the trade deficit. And it happened as a result of a decline in exports by 5.4% and an increase in imports. Imports went up by 3.6%. So this is the worst trade deficit in goods since March of 2025. So Trump promised that his tariffs were going to reduce our trade deficits. The trade deficits are rising. This is the biggest goods trade deficit in over a year, and it's headed in the wrong direction. And we lost twice. Imports up, exports down.
The long-term outlook remains centered on the idea that gold and silver are monetary assets rather than merely commodities. Although recent weakness has shaken investor confidence, it has not altered the structural factors supporting higher prices over time. Expanding debt levels, ongoing currency debasement, and the possibility of future monetary easing continue to reinforce the case for owning precious metals. Silver's previous surge from around $30 to $120 demonstrated how quickly the market can move when investment demand accelerates. If inflation remains stubborn, economic growth weakens, and policymakers eventually return to accommodative measures, another powerful advance could emerge. Under those conditions, a move back toward previous highs may only represent an intermediate step in a much larger bull market. The widely discussed $200 silver target reflects expectations that monetary imbalances and declining confidence in fiat currencies could drive substantial capital into tangible assets. As concerns about the economy, Fed decisions, and long-term purchasing power continue to grow, gold and silver may remain among the strongest beneficiaries of this shifting financial landscape. Share your thoughts about this interview in the comment section below. If you found this video helpful, please hit the like button, subscribe to the channel, and ring the bell icon. Thanks for watching.